Dividend investing in the UK, passive income explained simply. What if I told you there are companies right now, massive, well-known British companies, that will literally pay you cash just for owning a tiny slice of them? Not once. Not as a special favor. But every single quarter, deposited straight into your account, whether you lift a finger or not. That's dividend investing. And today, I'm going to break down exactly how it works, how to do it properly in the UK, and honestly, how much money you'd actually need to make it worth your while. Right. So let's start at the very beginning, because I think dividends are one of those things people nod along to without ever fully understanding. And there's no shame in that, I was exactly the same. A dividend is simply a payment a company makes to its shareholders. That's it. When a business makes a profit, it has choices. It can reinvest that money back into the business, it can pay down debt, or it can take a chunk of that profit and hand it out to the people who own shares. That handout? That's a dividend. So if you own shares in, say, Legal & General, or Shell, or Unilever, these companies regularly pay dividends. You own the shares, the money turns up. Could be every 3 months, could be twice a year, depends on the company. But the point is, you don't have to sell anything. You don't have to time the market. You just hold, and you get paid. Now, here's where people get excited, and rightly so. Because this is genuine passive income. Not passive income in the way some bloke on Instagram means it when he's trying to sell you a dropshipping course. Actually passive. You buy the shares, you hold them, money arrives. That's it. But, and this is important, let's talk about realistic numbers before anyone gets carried away. The average dividend yield on the FTSE 100 right now hovers around 3.5% to 4%. Some individual companies pay more, some pay less. But let's use 4% as a nice round number. That means if you invested £10,000 into a basket of dividend-paying UK shares, you'd earn roughly £400 a year in dividends. That's about £33 a month. Now look, I'm not going to pretend that's life-changing money. It's a nice meal out. Maybe it covers your phone bill. But it's not replacing your salary, is it? And this is where I think honesty matters. A lot of dividend investing content online makes it sound like you'll be sipping cocktails on a beach within 2 years. The reality is, dividend investing is a slow, steady, long-term game. It's a tortoise strategy, not a hare strategy. But here's the thing, the tortoise wins. Because here's where the magic actually happens, and it's a concept called dividend reinvestment. Instead of taking that £400 and spending it, you use it to buy more shares. Those extra shares then pay their own dividends. Which buy more shares. Which pay more dividends. And on it goes. This is compounding. And Albert Einstein supposedly called it the eighth wonder of the world. Whether he actually said that, who knows, but the maths doesn't lie. Let me give you a quick example. Say you invest £10,000, you add £200 a month, you get a 4% dividend yield, and you reinvest everything. After 20 years, without the share price moving at all, which is unrealistic but let's keep it simple, you'd have built up a pot worth over £80,000, generating more than £3,000 a year in dividends. And if share prices grow too, which historically they have, the numbers get significantly better. Now, let's talk about something that can make or break your returns, and it's something a lot of people overlook. Tax. In the UK, you get a dividend allowance. As of the current tax year, that's £500. So the first £500 of dividend income you receive, completely tax-free. Lovely. But anything above that gets taxed, and the rate depends on your income tax band. Basic rate taxpayers pay 8.75% on dividends above the allowance. Higher rate taxpayers pay 33.75%. An additional rate? 39.35%. Now that might sound annoying, but here's the really good news. There is a perfectly legal, incredibly simple way to avoid paying any dividend tax at all. And chances are you already have access to it. It's your stocks and shares ISA. Every UK adult gets a £20,000 ISA allowance each tax year. Any dividends earned inside your ISA are completely tax-free. No reporting to HMRC. No filling in self-assessment forms. Nothing. It just grows, quietly, in the background, and every penny is yours. This is genuinely one of the best perks of being a UK investor, and I'd argue it's underused. If you're serious about dividend investing, a stocks and shares ISA should be your first port of call. Full stop. And if you're thinking even longer term, retirement, specifically, there's also the SIPP, a self-invested personal pension. Dividends in a SIPP are also tax-free, and you get tax relief on your contributions going in. The trade-off is you can't touch the money until you're 57, rising to 58 from 2028. But if you're building for retirement, it's incredibly powerful. Right. So you're sold on the idea. Where do you actually put your money? You've broadly got three options, and I'll walk through each one. Option 1, individual shares. You pick specific companies that pay good dividends. In the UK, the classic dividend payers are companies like Legal & General, British American Tobacco, Rio Tinto, National Grid, Vodafone. These are household names that have paid dividends consistently for years. Some people love this approach because you're in control, you can research each company, and you can build a portfolio tailored to your goals. The risk, though? If one company cuts its dividend, and they do, ask anyone who held Vodafone recently, it can hit your income hard. You're also putting your eggs in fewer baskets. Option 2, funds and ETFs. This is where you buy a single product that holds dozens or even hundreds of dividend-paying companies for you. Something like the Vanguard FTSE All-World High Dividend Yield ETF gives you global exposure to dividend payers in one neat package. Or if you want to stay UK-focused, there are funds tracking the FTSE 100 or specifically targeting high-yield UK companies. The advantage here is diversification. One company cuts its dividend? Barely a blip. You're spread across loads of them. The downside is you pay a small management fee, but with most index funds and ETFs, we're talking fractions of a percent. Absolutely worth it for most people. Option 3, and this one is a bit of a hidden gem, UK investment trusts. These are a uniquely British thing, and they're brilliant for dividend investors. Investment trusts like City of London, Bankers Investment Trust, or Murray Income have something called revenue reserves. That means they can squirrel away extra income in good years and use it to maintain or even increase their dividend in bad years. City of London Investment Trust, for example, has increased its dividend every single year for over 57 consecutive years. Through recessions, through financial crises, through a global pandemic. Every year, the dividend went up. That's remarkable. And because investment trusts are listed on the stock exchange, you can buy them inside your ISA or SIPP just like a normal share. Now, let me address something that I know some of you are thinking. What about growth investing? Should I be going for dividends, or should I be buying the Amazons and the Nvidias of this world? Honestly? It's not either or. But I think dividends offer something that pure growth investing doesn't: tangible, regular income that you can see hitting your account. There's a psychological benefit to that. When markets drop, and they will drop, seeing dividends still land in your account is incredibly reassuring. It keeps you invested when your instincts are screaming at you to sell everything. And here's a stat that might surprise you. Over the very long term, a huge proportion of total stock market returns, some studies say as much as half, have come from dividends being reinvested, not from share price growth alone. Dividends aren't the boring cousin of growth investing. They're the quiet engine that drives a massive chunk of your wealth. Let me give you a quick practical checklist before we wrap up. If you want to get started with dividend investing in the UK, here's what I'd do. 1. Open a stocks and shares ISA if you haven't already. Platforms like Vanguard, Invest Engine, or Trading 212 make this dead simple and low cost. 2. Decide your approach. Individual shares, funds, investment trusts, or a mix. If you're newer to this, a diversified fund or ETF is probably the smartest starting point. 3. Set up a regular monthly contribution. Even 50 or 100 quid a month. Consistency beats timing every single time. 4. Turn on dividend reinvestment. Most platforms let you do this automatically. Tick that box. Let compounding do its thing. 5. And this is the hardest one, be patient. This is a years and decades game. The results in year 1 will feel underwhelming. The results in year 15 will feel extraordinary. Trust the process. And 6. Keep learning. Understand what you own. Check in on your investments a couple of times a year, not a couple of times a day. This should feel calm, not stressful. Dividend investing isn't glamorous. Nobody's going to make a Netflix documentary about someone who steadily built a £50,000 ISA over 15 years through boring monthly contributions and reinvested dividends. But that person? They're the one who actually built real wealth. Quietly. Consistently. Without losing sleep. That's the beauty of this. It works. It's proven. And it's available to basically every adult in the UK, right now, with whatever amount you can spare. If you found this useful, do me a favor, hit that subscribe button so you don't miss future videos like this. Drop a comment below and tell me, are you already investing for dividends, or is this something you're just starting to look into? I read every single comment, and I love hearing where you're at on your journey. And if you want to understand more about how ISAs work and how to pick the right one, I've got a video right here that breaks the whole thing down. Go watch that next. Thanks for watching. I'll see you in the next one.